Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Alconin, along with Dennis Dick, and we are joined by Joe Saluzzi, partner and co-founder of Themis Trading. Joe, how you doing this morning?
I'm doing great, Joel. How you guys doing?
We're doing good here, Joe, and you had a busy week here. Wednesday, you had that big Cowen Themis Market Structure Conference. Tell us about that.
Yeah, we had a really good event. It's our second one, and what we try to do is it's only a half a day event, and we invite clients and institutional investors, and we try to make it different than the normal, let's just say, Wall Street conference, where there's a lot of guys pitching their own book, and there's usually panels of guys, and most people have fallen asleep at that point. But ours was we bill it more as a teaching, where we kind of deep dive into a lot of subjects, and a couple of topics that we talked about. One was dark pools and how they operate and where the lags are. And there was a really good presentation given by Tab Group's Jeff Alexander and Linda Giordano. And so, we're getting to the next level of what's going on inside these boxes. And it's certainly disturbing when you find some things out where the latencies are and so on and how much it's possibly costing investors. So they're just starting to kind of dig through here. But basically what it means is that there's still a lot more to work to do when it comes to market structure.
Joe, talk about some of those latencies there. And I know what can happen here is if you're off the SIP and you're pricing some of these dark pool or midpoint prints, they can probably sometimes occur outside of the real NBBO. Were they talking about that?
Exactly. I mean, you hit it right on, and that's really where it is. If you've got a midpoint peg, let's say, and you're on a pool that's slow, and that maybe if it's not even against the SIP, it's just because that pool is slow to
That pool
update.
itself. Yep.
Yeah, the dark pool itself, and then you could be late. So you're maybe going up a half a penny. You were originally on that spread that moved basically. So does it create potential arbitrage opportunities for faster traders? Yeah, it probably does. And is it necessary? Well, maybe not. And that's where, you kind of have to really think about what's going on inside. And when you've got a third of the volume trading off exchange, it's a question. And it's not only off exchanges, actually, there's hidden volume on exchanges as well. And some
Yeah.
exchanges aren't that fast as well. So there's a lot of stuff that goes on, and that always comes back to the issue of fragmentation and all of these venues. And do you need them all? Are they serving a purpose, or is it more the unnecessary arbitrages that are being created? And it's still a question to be answered there.
Well, I mean, we've had this market structure, change so much over the course of the last 14 years. You had the monopoly, basically, and the monopoly's been broken now, and you've got, so many different places where these exchange, you got 11 or 12 different exchanges, you got 40 or 50 different dark pools. Do we see any type of consolidation here happening? Did anybody at your conference talk about potential consolidation, maybe getting rid of a few of exchanges, maybe some of these dark pools closing here? Because I think it has gotten to the point where the market is too fragmented.
Yeah, and I think there is actually a consensus starting to build that we do have too many venues, and across all different participants in the market, even some high-speed traders who you would think would say, okay, yeah, they need the fragmentation in order to create some of these arbitrages. A lot of them are frustrated too because what happens is they have to pay to connect to all of the venues, and that costs them money. And since their margins are shrinking now, the higher costs are actually eating into those profit margins. So there are too many venues, and a couple of suggestions were, okay, how about if we limit it to a minimum market share? In other words, if your exchange is only trading 2% of the market share, well, that's too little. You're no longer protected, and that's been out there as a potential proposal. If you drew a line and if you said 3% market share or less, you're no longer protected. Well, you get rid of about 6 exchanges overnight. So that could potentially start to aggregate liquidity, and I think the real issue that most people are starting to finally realize years into this is you can't fragment liquidity as much as we have it if you're looking to put up blocks or sizable trades.
Yeah.
You need to start to bucket this liquidity and really start to aggregate it and have those deep limit orders with various market participants, whether they're retail, institutional, high frequency, whatever it may be, starting to aggregate at points, and then you'll be able to move more size in and out. Because the real problem is, and one of the guys at the conference, actually the CEO of Cowen, Jeff Solomon, mentioned this at the beginning. He said, when you're an investor, a large investor, and you're looking to, say you did the research on a small cap stock and you like it and you think it's a great investment, what eats into your alpha is transaction costs. And if you look at the stock and you say, you know what, there's really not enough volume here, or there's not enough liquidity, and we use the terms very carefully, obviously, volume and liquidity, then you won't invest in the stock because there's nothing in there, and you know that your transaction costs will be too high, which will lead into your alpha. So the question is now in the industry is how do you help liquidity in these smaller cap stocks so you can attract new investors, so you can aid in capital formation and allocation, which is what the stock market's supposed to be all about in the first place.
And we're going to have the tick size pilot come out probably towards, obviously, I think they put a date on that has to start. I think it's by like May of 2016. So they have some time here yet. Now, that obviously, when you talk about fragmentation, if you want to talk about it too, it actually started with decimalization because really we went from 16 pricing increments per handle to 100 pricing increments per handle. So that fragmented liquidity in itself. Then we fragmented all the venues, and now we're obviously very fragmented. So, like you're right, when you talk these small little stocks, you're seeing 100 shares on the bid, 100 shares on the offer, and then obviously if you bid for the stock, you get the penny jumpers popping in there, and the penny jumping algorithm, and it steps ahead of you too, and it's very difficult to get filled. I mean, I have trouble trading these stocks with 500 shares. I can't imagine trading them with 5,000 or 50,000 shares. It would be nearly impossible. So, do you think the tick size pilot is going to help with that when they actually get this in, because it's actually going to bring us from the back to nickels here at least, and we're down to 20 increments, and maybe that brings some of this liquidity back to some normal levels here? What are your thoughts?
Yeah, I think it's an experiment and it's a pilot, right? And it's going to take some time for it to yield some results. So, and I think it's somebody's sick idea over there with the regulators. It's actually May 6th of 2016 when it's effective. And
it's on the flash.
Yeah. I don't know if that's some sort of bad joke that they did, but of course, the flash crash anniversary. But it does. I think it does hold a lot of promise. But I think it's going to take some time to yield a result. So if all of a sudden within 3 or 6 months they do an analysis and it says that we're not, nothing's happening here, well, that's because behavior hasn't changed yet. And market makers like yourself, when you were making markets, you haven't been able. Let's just say, if you're going to come back into those names, if you realize someone's not going to jump you, and if you realize that your displayed liquidity is now going to be part of the market, and the pay to play is not as much. But it's going to take time, I think. So it's got a 2-year pilot on it. It's got a 2-year extension. Actually, they originally put it out as 1 year, but they extended it to 2, which we think is a good idea. And we'll see. But like I said, it's a pilot. I think it was a good idea. We supported it. There are different buckets in how you're going to trade. There's some that have a trade-at rule, some stocks, some that don't, some you can trade in the middle of the spread. So like I said, the jury will be out, but certainly the results are going to be watched carefully. And I think the one component that does have a trade at, in other words, you cannot trade on a dark venue until you clear the lit one out, that's going to be the one that scares the industry the most, because if that's successful, there's a lot of guys out there who built business models against that could be in for some trouble.
The one problem, though, with that trade at is that they put an exemption in there for retail order flow. And this is something that, our company, Bright Trading, had commented on as well. And basically, any retail order flow is exempt from it. So they can actually still, off-exchange market makers can still match the quotes if they're matching against a retail order and giving some, type of, minuscule price improvement here. What are your thoughts on that? Is that going to possibly compromise that, liquidity?
Yeah, when we wrote our comment letter, we wrote also saying that there are too many exemptions, and there are other ones out there as well. And the more exemptions you put in, the less pure a pilot could be,
Yes.
The less pure the results will be. And yeah, I don't think that was necessary. I think that you really wanted to build out and bucket that liquidity, because I think if it's a straight retail order for 100 shares and it's a legitimate bona fide retail order, okay, I can understand a little bit. But I think that there will be a little bit of shenanigans going on, and maybe they're not necessarily retail. And I think the regulators have to be careful there and watch it. But like I said, we'll see. There are other ideas out there on how to bucket liquidity, regional or not regional, venture exchanges, and trading on one only in one exchange. Actually, BATS came out recently and proposed, the BATS exchange proposed that some stocks should only have to trade on one exchange. Don't allow them to trade in multiple spots in order to bucket liquidity until they graduate to the next level, and then they're able to kind of like a child moving through. And it's an interesting concept as well. And I think at least the debate is happening, and people are now talking about it. And what they're doing is they're admitting that the current market structure has failed. It is not good enough when it comes to capital allocation and formation, and we need to move on. And this joke about liquidity always being there when you need it and all the rest of it. Well, we know that's not true in times of stress. So it's finally gotten to that point, years after the flash crash, years after we started this conversation, where some real debates are being had. Conferences like ours or roundtables at the SEC and so on. they're getting there. It's at a glacier pace, but we're finally starting to move.
Joe, what were some other thoughts from the conference there? Obviously, they had a lot of big speakers there. Was anybody talking, high frequency trading? And what were some other, thoughts from that conference?
Yeah, one panel which was interesting, and I think people would find it interesting, was I interviewed actually two executives from Virtu Financial.
Yeah, that's
which
awesome.
Yeah, it was a really good panel, and listen, we're guilty of it as others are when we bucket high frequency trading. We always say high frequency trading. Well, what does that mean? I was on a CFTC panel and we couldn't even define that a couple of
Yeah.
years ago, and the Virtu guys were very specific about what they do, and they're electronic market makers, right? And they made a difference between, whether it's somebody out there, they're not doing the predatory type of stuff. They're out there making markets in over 200 markets around the world in various instruments. And I looked at their S1, they only make 25% of their money from equities, and the balance is from other products, currencies, bonds, and so on. So these guys have this much bigger picture of the world. But with that said, there are others out there that certainly have more of a predatory sniffing, pinging mentality strategy. That's not what they do. And they were very, good at explaining what their role is and how they do it. And they actually agreed with us on a lot of things when it comes to things like fragmentation and reducing venues and so on. So it was definitely enlightening. We had another panel where the SEC, a gentleman named Austin Garrett, came up and he was talking about what they have at the SEC and actually the lack of data that's out there, and how when they need to go out and look for something, they have to request the data from the exchanges, which takes a while. So it made me feel a little bit less comfortable with regulators and how they can access quickly what they need to look at. And that's why obviously people are waiting on the consolidated audit trail, but which is still years away. And the problem there is that there's no futures. It's only two products. It's stocks and options that are going to be in the consolidated audit trail. So, he was really good. Austin was a forward-thinking guy. He's a researcher who really seems to want to push it forward. So, we were thrilled to have him there. And then we had two guys, of course, the IEX, our good buddies at IEX, Ronan Ryan and Brad Katsuyama came, and they had like more of an open discussion. This is like the first time I think they've been on stage together in a while, because they tend to separate. They're in such high demand nowadays. They can't be in one spot at the same time. And they gave a good update as to what they're doing. They're filing for an exchange. They're becoming, within, I don't know how long it's going to take them, but they're in the process of being an exchange, and all the good things going on there. And it just so happened that day we actually, over here at Themis, we put up a big block trade with them, with IEX that morning, and they were talking about that, so we were pretty thrilled about that.
Nice.
Yeah, Joe, I was just going to ask you about that. We're on the line with Joe Saluzzi. He's a partner and co-founder of Themis Trading, talking about the high-frequency conference they had along with Cowen. How is the volume doing over there? Are they just, incrementally getting more and more volume? You just mentioned a block trade here. I probably don't want to reveal the volume of it, but how's the daily volume been trending on the IEX?
They are going higher. Actually, they had a record day. I think it was last week. I think they were at 1.6%, I think they said.
Nice.
But they are trending higher, and still the volume and the type of activity you see in IEX is unique. It is larger. It is chunkier. When you match up, and what we find is that, we're trading all institutional orders, and if I match up on IEX for, say, 10,000 shares or something, I know I can go back there and try to get more. I know that the other side also wants to move stock. I know there's liquidity, right? That's the term liquidity that we all use that tends to be, lost somewhere along the way. That 10 may turn into 20, which may turn into 50, which may turn into 100, all with minimal leakage in the system, minimal penny jumpers trying to mess around with you. And that's what we're supposed to be doing here. I'm allocating. The seller wants out, the buyer wants in. It's wonderful. Let's match them up. And they are doing a fantastic job of getting those type of trades up there. I mean, they're very progressive in their thought process. They have something called tops now, which is they're lighting up a portion of their book on their displayed piece, which is starting to attract some more business. And again, it's kind of like a stickiness, I think. They want to aggregate that flow. They want to get those chunks done. And there were others, by the way, who have tried this, and some have succeeded, like LiquidNet, and there's another dark pool coming up called Luminex, which is going to be out by the end of the year, apparently, and that's going to be owned by a bunch of buy-side guys. And, if they build a different type of mousetrap, well, maybe that will help. But we're all, again, going back to the same original theory. How do I reduce fragmentation and add, and really put significant liquidity into the system? So I think they're doing a great job at IEX, and we've been huge supporters, and we're going to continue to support them.
Joe Saluzzi, partner and co-founder of Themis Trading, joining us here on Benzinga's Pre-Market Prep. Joe, great to talk to you. Have a great day. Enjoy that Russell rebalance, and we'll talk to you again soon.
Thanks, Dennis and Joel. Talk to you guys soon.
Thanks, Joe.